嗨，大家好，今天我们来聊一个，听起来可能有点无聊，但实际上却是支撑着整个商业世界运作的核心哦，那就是一家超大的公司到底是怎么付钱的。你可别以为这只是按个转账那么简单，不，这背后根本就是一门艺术，一套学问，就是要确保公司的每一分钱都花得明明白白。好，我们马上来看看。
你心里可能想说不就收到账单付钱搞定，有这么难吗？但你想想哦，对一家大企业来说，事情真的不是这样。为什么他们偏不要把事情搞得这么好像很复杂？其实答案很简单，但也非常关键，就是2个字：规模还有风险。
那你想象一下那个画面，一家跨国公司每天要处理的发票可能是几千几万张，来自世界各地的供应商。这时候如果有人手滑多打一个0，或者同一笔钱付了2次，更惨的是付钱给一个根本没送货的厂商，哇，这些看起来小小的错误，全部加起来那个损失可是会吓死人的。所以他们当然需要一套绝对不能出错的系统。
那这套系统的核心精神是什么呢？其实就是一个概念，叫做3项匹配。你记住这个词这几乎是所有大公司付款流程的黄金准则。目的嘛，就是要确保账单上面写的每一个字、每一个数字都100%正确。没错，就是这句话，是不是讲的超白话、超有道理？这就是整个验证流程最重要的精神。其实就跟我们平常去买东西一样嘛，你不会店家说多少就傻傻的付钱，对吧？你一定会先想一下，我当初订的是什么，我手上拿到的是什么，然后账单上写的又是什么，这3样东西一定要对得起来才行。所以呢，所谓的3项匹配，指的就是要核对这3份超级关键的文件。第一份叫做采购单，也就是 PO， 这代表我们一开始跟厂商说好要买什么，买多少，多少钱。第二份是收货单 GR， 这是我们仓库收到货之后开出来的证明，代表我们真的有拿到东西。那第3份呢，才是供应商寄来的发票 Invoice， 也就是账单。这3份文件就像拼图一样，必须要完美的对在一起。
所以最理想的状况就是，你看采购单上订了100个，仓库也点收了100个，发票上也请款100个 ，perfect， 完美，系统就会说 OK 付钱。但人生总是有个 but， 如果采购单订了100个，结果仓库只收到80个，但发票却还是要收100个的钱，那这时候系统就会马上哔哔哔亮起红灯，这就是我们说的差异产生了。
好，那问题来了，当这些文件上的数字对不起来的时候，到底会发生什么事呢？这就是这套发票验证系统真正厉害、真正展现它价值的地方了。最常遇到的问题就是数量对不起来。这个原则非常简单，也很好懂。公司只付钱给实际收到的东西，所以如果厂商寄来的发票上面的数量比我们仓库的收货记录还要多，那抱歉，系统会直接把这笔账单挡下来，绝对不会付出去。另外一个也很常见的问题就是价格。当初不是说好一个100块吗？系统会自动去比对发票上的单价跟采购单上我们一开始同意的价格。如果供应商自己默默涨价了，或是算错钱，系统也会马上抓出来，然后跳出警告。不过呢，大公司做事也是很务实的啦。你想想，如果为了那种1、2块钱或是0点几个百分比的超小差异，就把整个付款流程卡住，那也太没效率了。所以系统通常都会设定一个容许差异的范围，只要误差是在这个小小的范围之内，好，没关系，系统就当作没看到，让它自动通过。那如果这个差异不幸超过了那个可以容忍的范围呢？这时候系统就会启动一个大绝招，叫做付款冻结。这就像是踩了一个紧急刹车，把这笔有问题的付款冻住，不让它出去。然后呢，就要等采购人员或会计人员亲自来看看是怎么回事，把问题查清楚，手动批准之后，钱才付得出去。当然，你以为只有数量跟价格吗？现实世界永远更复杂。比方说，还有运费这种额外的成本，有些是我们早就谈好了计划内成本，但有时候也会有那种临时追加的非计划成本，像是这批货很急，帮我用最快的快递送，那个费用就不一样了。
甚至连到货的日期都可能会产生问题。这些状况，系统都必须要有能力去处理。
讲到这里，你可能会觉得，哇，规则这么多，会不会很麻烦啊？有没有办法让整个流程再自动一点，再聪明一点呢？答案是当然有。现代的系统其实有很多超聪明的方法。
来，这里介绍几个很酷的自动化方式。第一种叫做评价收货结算 ERS， 这超猛的。在这种模式下，你跟那些合作很久、很信任的供应商之间，甚至可以连发票都不要了，只要你家仓库确认收到货，系统就会自己根据采购单的价格，自动把钱付出去。再来，有一种叫寄售，意思是货虽然都放在你公司仓库了，但东西还是厂商的，要等你真的把它拿去用了才需要付钱。最后，还有像我们缴水电费那样的管线模式，就是根据你实际用了多少度电、多少吨水，系统再来自动算钱。这些方法都是为了让整个供应链的钱流动得更顺畅、更有效率。
好了，我们把整个流程从头到尾看了一遍，现在我们来做个总结，回头看看，搞懂这一切到底为什么这么重要。
其实啊，这背后藏着一个很关键的会计概念，叫做 GR/IR 账户。你不用记这个名字，你只要把它想象成一个财务的等候室。你看到，当货送到的时候，这批货的价值就会先进到这个等候室里，然后等发票来了，也确认都没问题了，系统才会把钱从这个等候室里拿出来，付给供应商。你看，这样是不是就确保了公司的账永远都是平的，1块钱都不会差？
所以说，我们来总结一下，一套好的发票验证流程，最基本的功能当然是防止我们付错钱、多付钱，但它的好处远远不止这样。它能确保公司的会计记录是干净、准确的，未来要给会计师查账也没问题。更重要的是，当你付钱又快又准的时候，供应商也会更信任你，更愿意跟你合作，这是一种双赢。而且它还能检查发票号码，防止有人拿同一张发票来报2次账。最后，让我们来想一个大问题：全世界每天有几兆、几十兆美元的交易在发生。如果今天我们把这个看起来好像有点啰嗦，但却超级重要的核对步骤拿掉，你觉得我们的商业世界会变成什么样子？所以你看，懂一点发票验证，其实就是懂了现代商业是怎么运作的其中一个核心秘密。好，感谢你的收看，我们下次见。
Hello， 欢迎收听的 Deep Dive。今天呢，我们要来深入探索一个在 SAP 采购流程里面非常关键，但有时候又让人有点雾里看花的环节，就是这个发票验证 （Invoice Verification）。想象一下供应商的发票寄来了，然后呢，直接拿去付款就好了吗？事情当然没那么简单啦。我们看到的资料里面常常会看到 IR， 就是 Invoice Receipt， 还有 Verification。这2个词听起来好像蛮像的，但其实是2回事。收到发票那个 IR 只是第一步，
对，
真正的重点其实是在后面的验证 verification。
没错没错，这个发票验证的核心任务啊，说穿了就是要确保我们付出去的每1块钱都是对的，是合理的。就是说，供应商发票上面的金额啦、数量啦，是不是真的跟我们当初那个采购单，就是 PO 上面讲好的，还有仓库实际收到的货 GR， 是不是都对得起来？这个就是 SAP 系统要来帮我们仔细核对的地方。系统会去看那个 PO 的历史记录 PO history， 看看你到底收了多少货啊，这张发票之前处理过了没啊，这样才能防止说不小心重复付钱，或是付了超过实际收到的货的钱。
听起来这个验证步骤根本就是一个品质控管嘛，避免付错钱。好，那我们就来一步一步拆解这个过程。这是我们的探索任务，就是要带你彻底搞懂 SAP 发票验证到底是怎么运作的，有哪些重要的观念，还有它怎么跟采购单收货啦，甚至更源头的那个物料主档设定是紧密连在一起的。准备好了吗？ OK，let's unpack this。所以收到发票不等于说马上就要付款，这个验证的动作具体来说，它到底在比对哪些资讯呢？
主要就是在做一个三方比对。哪三方呢？就是发票它本身的资讯，还有我们系统里面采购单就是 PO 的资讯，再来就是收货 GR 的记录。SAP 会去核对，比方说发票上的单价啊、总金额跟 PO 上是不是一样，发票上写的数量有没有超过我们实际收到的数量，这个实际收到的数量就是看 GR 的记录啦。这些比对都是为了确保交易是正确的。
那系统在比对的时候，这些资料是从哪边抓来的啊？听起来那个采购单 PO 是最重要的依据了。
对，你说的没错，最直接的比对对象就是这笔交易的采购单 PO。不过PO 上面的价格资讯也不是说凭空冒出来的哦，它通常是继承自就是我们跟供应商啊可能事先谈好的一些长期的价格条件，这些条件有可能记录在叫做采购资讯记录 info record 或是合约 contract 这些主档资料里面，我们把这些统称为主档条件 master condition。
所以那个流程是这样 ：info record 或 contract 的价格先带到 PO 里面，然后发票寄来了，再来跟 PO 做比对。那我有个问题，为什么发票不干脆直接跟 info record 比对就好了？那个不是更源头吗？
这个问题问得很好，因为每一张独立的 PO 它可能会有当下那一次交易特定的条件或价格调整，这个东西叫做文件条件 document condition。 比方说啦，这次采购可能有一次性的特别折扣，或者是临时加了一笔什么急件处理费，这些条件就只适用于这张 PO 而已哦。所以说，验证的时候必须要以这张 PO 上面最终确认的条件为准，这样才能确保这次交易的精确性。除非是一些比较特殊的自动结算的情境，像是那个寄售 consignment 或是管线物料 pipeline， 系统才有可能在特定的设定下直接去参考 info record 的价格。但一般来说啦， PO 才是这次交易真正的最终的契约。
了解。我们刚刚谈了主要的物料价格怎么来的，不过采购通常不只有物料本身的钱嘛，常常还有一些运费啦或其他杂七杂八的费用。资料里有提到那个 delivery cost， 这个在发票验证的时候也要处理吗？
是的，要处理这些额外的成本，像是运费、关税、保险费这些，我们就统称为 delivery costs。 它们又可以分成两大类，计划内 planned跟计划外 unplanned。 如果在建立 PO 的时候就已经知道会有这些费用，而且也在 PO 的价格条件 conditions 那边加入了对应的项目，比如说除了物料单价 PB00， 另外又加了一个运费条件 FR01， 像这种情况就属于计划内的成本。
那计划外听起来就像是意料之外跑出来的费用。
对，差不多可以这样理解。比方说，你原本的 PO 没有谈运费，但后来因为生产很急，你临时要求供应商用空运快递寄过来，那多出来的这笔快递费就是计划外的 unplanned。 这种费用因为在 PO 上面没有预先记录嘛，所以就得在做发票验证的时候，额外用手动的方式输入到发票的总金额里面去。那这些成本，不管是计划内还是计划外，最终怎么影响物料的价值，这个又会跟我们等一下要谈的物料主档设定有关系了。
哇，发票验证居然还跟物料主档 Material Master 有关哦。我还以为价格跟条件主要看 PO 或 Info Record 就差不多了耶。
关系可大了，至少有3个很关键的连接点。第一，也是影响成本计算方式的，就是物料主档里面的价格控制 Price Control 这个设定。这里决定了这项物料是用标准价格 Standard Price 代码是 S， 还是用移动平均价 Moving Average Price 代码是 V。 这个选择直接影响到，如果发票价格跟 PO 价格不一样，有差异的时候，这个价差要怎么处理。假设是用 S 价标准价格，那价差通常会被当作是一种营运上的差异，过账到特定的价差会计科目，可能是费用科目，也可能是收入科目。 但如果是用 V 价移动平均价，那这个价差通常会直接去调整库存的成本跟价值。也就是说，它会影响到你账上这批货的单位成本。所以你看，一开始在物料主档选对价格控制方式，就直接决定了后面发票有价差的时候，账是记在损益表 S 价的情况，还是直接影响你资产负债表上的库存成本 V 价的情况。这个对成本分析跟库存评价来说影响很大哦。
原来如此。那第二个关键点呢？
Valuation class， 你可以把它想象成是这个物料的会计身份证啦。它决定了这项物料相关的所有库存交易，比方说收货啦、发货啦，还有发票验证产生的库存价值变动等等，应该要连接到总账 General Ledger 里面的哪一个会计科目。例如，就是透过这个评价类别，系统才知道说，原物料的库存价值要进哪个科目，半成品的要进哪个，成品的又要进哪个，这样才能确保账务分类是正确的。
了解，像贴标签一样。那第三点呢？
第三点则是付款条件 （payment term）。虽然说系统在带入付款条件，像是那个付款期限啦、现金折扣条件啦，它的优先顺序通常是 info record 最优先，再来是 PO， 最后才是物料主档。但是如果前面这两个来源都没有设定的话，那物料主档就是最终的那个预设值来源了。这里还有一个小细节，物料主档里面有2个地方可以设定付款条件。一个是针对整个公司代码的视图 Company Code View， 这个比较通用；另一个是针对采购组织的视图 Purchasing View， 这个就更具体。系统会优先采用采购组织层级的设定，因为它通常更贴近实际的采购作业情况。
原来物料主档的设定影响这么深远啊！好，了解了这些背景资讯之后，那实际在 SAP 系统里面操作发票验证，大概是怎样的一个流程呢？是一次就要把所有事情都搞定，还是说可以分阶段来处理？
这部分其实可以很有弹性也主要还是看公司的内部流程怎么设计，还有权责怎么划分的。最简单的就是所谓的一步骤 one step 处理，负责的人员直接就在系统里面输入发票的所有必要资讯，然后进行比对验证，确认都没问题之后，就直接给它过账 post 下去。这个 post 的动作非常关键它代表这个交易在系统里面被正式确认了，会产生后续的会计影响。另外一种也很常见的是2步骤 two step， 甚至可能是多步骤的流程。比方说，可能先由收到发票的部门，像是仓库或收发室的人员，先在系统里面输入发票的基本资料，做一个叫做预存 Park 的动作。Park 这个动作就像是先把资料暂时存起来，但还没有做最终的确认，也没有正式的会计过账。然后呢，再由权责部门，比如说采购部或财务部的人员，去把这些预存的发票叫出来，进行最终的检查、比对，可能还需要修改，最后才执行那个过账的动作。有些公司还会用到一个中间状态，叫做完成暂存 Save as Complete， 意思是说资料都输入完整了，只是在等最后的批准去过账。这种分阶段的处理方式，对于职责分离跟内部控制是蛮有帮助的。
了解。那执行了那个关键的过账 post 之后，系统里面具体会发生什么事情啊？它代表了什么意义？
过账就代表这张发票的验证流程在系统里面算是正式完成了，而且产生了实质的影响。最主要的，它会产生至少2份很重要的电子文件。第一份叫做发票文件 Invoice Document， 它是属于物料管理模组 MM 的，里面详细记录了这一次发票验证的所有内容，像是发票号码啦、日期、金额、数量、参条的 PO 是哪一张等等。你可以把它想成是这次发票处理的一个 MM 的记录档。第二份，这个对财务来说是最重要的，叫做会计文件 accounting document， 它是属于财务会计模组 FI 的。这个就是我们平常俗称的传票或分录啦，代表这笔交易已经正式影响到公司的财务账簿了。比方说，最基本的情况可能就是借记那个 GRIR 清账科目，然后代记应付账款科目，可能还有进项税额科目。同时系统也会自动去更新这张采购单的 PO history， 把这次发票验证的记录，包括文件号码、日期、金额、数量，都加到那个历史记录里面去，让整个采购流程的状态可以保持在最新。这个过账的动作也等于是触发了后续付款流程的准备工作了。
哇，刚刚听到会计文件会自动产生，这听起来很神奇，但感觉也很复杂耶。系统是怎么知道要用哪些会计科目的比如说应付账款库存费用等等，这么多科目它是怎么自动判断的？
这确实是 SAP 很强大但设定也相对复杂的一个地方。这个机制叫做自动决定会计科目Automatic Account Determination， 它的目标就是希望让日常的交易，像是收货啦、发料啦、发票验证这些，都能够自动产生正确的会计分录，减少人工判断的需要，也减少错误。与其我们去深入探讨所有那些技术名词，像什么 Value String 啦、Transaction Event Key 啦，不如我们专注在它背后的那个逻辑。你可以把它想象成是一个查表的过程，系统主要根据几个关键的资讯来决定要用哪个科目。第一，你交易的是什么种类的东西？这个主要就是由物料主档里面的那个评价类别 Valuation Class， 也就是我们前面提到的区分原料、半成品、成品等等的那个设定。第二，你对这个东西做了什么动作，也就是所谓的移动类型 Movement Type。比方说，你是收货入库Movement Type 101，还是从库存发料到生产线 Movement Type 261，或者是报废 Movement Type 551，不同的动作会影响到不同的会计科目。第三，有时候还要看为了什么目的，例如同样都是从仓库领用物料，你是领去生产工单用，还是领去做研发费用，或者是给部门当日常消耗品，这时候可能会有一个叫做科目修改码Account Modification 的东西来做进一步的区分。系统就把这些资讯，像是评价类别啦、移动类型啦，可能还有科目修改码等等，把它们组合起来，然后去一个中央的设定区，主要是在一个叫做 OBYC 的交易码里面设定的，去找出预先定义好的规则表，找出对应的那个总账科目 GL Account。比方说，原料 A 某个评价类别做收货某个移动类型，系统一查表就知道库存要进哪个科目，那个 GRIR 暂记科目要用哪一个。虽然第一次设定的时候需要仔细规划了，但一旦设定好了，就能确保大部分交易的会计分录是自动、准确而且一致的产生。
用查表这个比喻清楚多了，所以是根据物料种类做了什么动作，还有为了什么目的，系统就能找到对应的会计科目。那除了像刚才说的，可能需要人工输入啦、比对啦、过账的这种发票验证方式，有没有更自动化的做法啊？毕竟有些交易可能量很大或者很固定嘛。
绝对有 ，SAP 提供了好几种自动结算的程序，可以大大减少人工处理发票的时间跟力气。一个很常用的叫做 ERS，Evaluated Receipt Settlement， 中文翻成评价收货结算。在这种模式下只要你跟供应商事先讲好，并且在系统里面完成相关设定，那么当你收到货，并且在系统做了收货过账 GR posting 之后呢，系统就可以根据你收货的数量，还有 PO 上面的价格，自动帮你产生发票文件跟会计文件，等于是自动完成了发票验证的动作。这种情况下，供应商甚至不需要寄实体的发票给你了。这对于那些交货很频繁、价格又很稳定，而且是信赖度很高的供应商来说，效率真的非常高。另外还有针对一些特定物料供应模式的自动结算，比方说寄售 consignment 物料，这种物料虽然是放在你的仓库里面，但是在你实际从这个借售库存领用之前，它的所有权还是属于供应商的。那系统就可以设定成根据你实际领用的数量，定期比如说每个月自动产生结算文件，然后跟供应商付款。 还有像管线 pipeline 物料，像是工厂用的水、电、瓦斯这些东西，它们是透过管线供应的嘛，没有传统意义上的收货动作。系统通常会根据记录下来的实际使用量，可能是来自抄表读数的输入或系统借接，然后搭配预先在 info record 维护好的单价，来自动计算费用，并且产生结算文件。
ERS 听起来很方便。那资料里还有一个叫做发票计划 invoice plan 的，听起来也是自动化的，它是用在什么样的情况呢？
对，发票计划是另外一种很实用的自动化工具哦。它特别适合用来处理那些有固定付款周期、固定付款金额的采购项目，或者是需要按照预定的排程来分期付款的状况。最典型的例子就是支付租金，像是办公室租金啦、仓库租金啦，或者是长期租赁的设备费用。这些费用通常每个月或者每季、每年的金额跟付款日期都是固定的嘛，你就可以预先在采购单里面设定好这个发票计划，定义好每一期的付款日期跟金额，时间一到，系统就会自动产生对应的发票记录，准备进入付款流程，这样就省去了每一期都要人工去处理发票的麻烦。而且发票计划不只是用于这种定期定额的周期性付款，也可以用来处理所谓的部分付款，也就是分期付款。比方说一个大型专案的费用，合约里面约定好要按照专案的里程碑分阶段来支付，那你就可以在发票计划里面设定好每一个里程碑对应的付款日期跟金额，让系统到期的时候自动帮你立账。
哇，这些自动化的方式听起来确实能省下不少力气耶。但反过来说如果不是自动结算，而是人工在验证的时候，发现发票上面的资讯跟我们的 PO 或 GR 对不起来，比如说金额错了，或者数量不对，这时候系统会怎么处理啊？
这种情况就是我们所说的差异 variance。差异可能发生在很多方面啦，最常见的有几种。第一种是数量差异 quantity variance， 就是发票上的数量跟你收货单上记录的数量不一样。第二种是价格差异 price variance， 发票上的单价跟你采购单上约定的单价不一样。还有一个比较特别的叫订单价格数量差异，这个通常发生在 PO 的订购单位，比如说公斤，跟发票或者库存计价的单位，比如说公尺不同的时候，换算的过程中可能会产生一些微小的总价差异。另外还有像是交期差异，例如供应商交货的日期比 PO 上约定的日期提早太多了。那为了管理这些差异，避免付错钱嘛， SAP 允许你在系统后台去设定所谓的容差范围tolerance limits， 你可以针对不同类型的差异去定义系统可以接受多大的误差范围。比方说啦，你可以设定价格差异在 2% 以内，或者是金额差异在100块钱以内，系统可能只会显示一个黄灯的警告讯息，提醒你注意一下，但还是允许你过账。但是如果这个差异超出了你设定的容差范围，那系统通常就会亮起红灯，显示错误讯息，并且在大多数情况下会自动对这张发票加上一个付款冻结 payment block 的标记。
这个容差设定听起来就像是个守门员嘛，小的差异就提醒一下，大的差异就直接把它拦下来。那除了刚刚提到的数量啦、价格啦、交期差异之外，还有哪些常见的情况会导致发票被冻结付款呢？
除了超出容差的数量跟价格差异之外，尤其是在我们下面会提到的那个 GR-based 的验证模式下，数量管控会更严格，还有几个也蛮常见的冻结原因。品质检验 quality inspection， 如果你收到的货物需要先经过品保部门检验，那在检验结果出来并且确认合格之前，对应的这张发票可能会被系统自动冻结起来。随机冻结 stochastic block， 系统可以设定成按照一定的比例随机冻结一些发票，算是一种抽查的控制手段。还有就是人工冻结 manual block， 使用者这处理发票的时候，如果发现有其他问题需要先厘清，比方说发票内容看不清楚啦，怀疑是不是重复收到发票啦等等，也可以手动为这张发票加上付款冻结的标记。那一旦发票被冻结了后，它就没办法进入后续的付款流程，必须要先找出造成冻结的原因，并且把它解决掉。比方说，如果是数量差异，可能就要等后续的货送到，把数量补足；如果是价格差异，可能就需要跟采购部门或供应商去确认正确的价格。问题解决之后，还需要执行一个叫做释放冻结 （release block） 的动作，通常是透过特定的交易码，像 MRBR， 由被授权的人员来执行，才能解除这个冻结状态，让这张发票可以被财务部门纳入付款作业。你可以想象嘛，如果发票一直被冻结在那边，供应商肯定会不开心啊，甚至影响后续的合作。所以，能够快速厘清冻结的原因，并且释放，对于维持供应链的顺畅也是蛮重要的。
你刚刚提到好几次那个什么 GR-based invoice verification， 还特别强调说在这种模式下，数量管控会更严格。这个跟另一个听起来相对的 PO-based 到底具体差在哪里啊？听起来这好像是一个蛮重要的选择。
没错，没错，这是在发票验证流程里面一个非常关键的控制设定哦。它直接决定了系统在验证发票数量的时候，那个严谨的程度到哪里。GR-based IV， 也就是收货基础的发票验证。当你为某个供应商或者某一张 PO 设定了这个选项的时候，就代表你采取了没收到货就不认账的这种比较严格的模式。系统会很严格的去检查你这张发票要报销的数量，绝对不能超过针对这张 PO 已经完成收货过账的总数量。举例来说 ，PO 订了100个，你只收了80个，那就算供应商寄来100个的发票，在 GR-based 的模式下，你最多也只能验证80个对应的金额。这个方式能很有效地防止公司为还没有收到的货物付款，是比较常见也比较推荐的一种内控方式了。PO-based 的 IV 采购订单基础的发票验证。这种模式就相对宽松一点点，它允许你验证的发票数量最高可以达到该 PO 项目的总订购数量，即使你实际的收货数量还没有达到那么多。延续刚才的例子 ，PO 订100个，收了80个，发票来了100个。在 PO-based 的模式下，系统可能允许你先验证这100个的发票。但是请注意，就不代表系统就完全不管了。通常在这种情况，也就是发票数量大于已收货数量，系统还是会根据你容差的设定，跳出黄灯警告，或者如果差异实在太大，甚至可能直接触发付款冻结，变红灯，来提醒处理的人员要注意潜在的超付风险。这个设定通常可以在供应商主档的采购视图里面设定一个预设值，也可以在建立采购单的时候，针对特定的项目去做修改。至于要选择哪一种方式，主要还是取决于公司对于内部控制的要求有多严格，跟供应商之间的信任程度怎么样，还有管理上的便利性等等考量。
了解。所以 GR-based 就像是一个比较严格的保全 ，PO-based 比较像是一个有弹性，但是还是会提醒你的门卫。那最后还有提到一些听起来比较特殊的处理方式，像是那个 invoice reduction 跟 prepayment， 这又是什么样的情境会用到啊？
Invoice reduction 中文可以翻成发票金额减少啦。它提供了一种处理供应商发票错误，比如说金额开太高了或数量开错了的替代方案。一般情况下，你可能会把错误的发票退回给供应商，请他们重开一张正确的。但是 Invoice Reduction 允许你在系统里面直接处理掉。当你输入这张错误的发票的时候，可以选择一个减少发票的原因代码，然后输入正确的金额或数量。当你过账的时候，系统会很聪明的自动产生2份文件，一份是根据你输入的 那个错误但已经调整过的发票资讯产生的正常发票文件，另一份则是一张带项通知单 credit memo， 金额就是原始错误发票金额跟你调整后金额之间的那个差额。这样做的效果就是，你一方面接受了供应商的原始发票号码，方便对账嘛，另外又透过系统自动产生的 credit memo， 把多付的金额给冲销回来了，确保账务是正确的，同时也省去了退回发票和等待重开发票的时间。至于 prepayment， 也就是预付款，这个功能就更特殊了，它允许你在实际收到货物，也就是做 GR 之前，就先针对某一张采购订单 PO， 在系统里面进行发票的预存 Park， 甚至在某些配置下可以提前完成付款。这听起来对于那些需要先支付定金或部分款项，供应商才愿意开始生产或出货的交易，好像很方便，对不对？但实际上这个功能有不少限制。例如在台湾因为那个进项税额的申报跟抵扣时间点通常跟你收到发票或收到货物有关嘛，直接做预付款可能会产生一些税务处理上的复杂问题。另外，如果公司系统有启动那个物料账 Material Ledger 这个比较进阶的成本核算功能，预付款也可能跟它的运作逻辑产生冲突。所以，虽然 SAP 有提供预付款的功能选项啦，但在台湾的实务应用上，相对是比较少见的，需要非常谨慎的去评估它的适用性。
好的，哇，我们今天真的是从头到尾很深入的探索了 SAP 的发票验证这个流程耶。从一开始厘清收到发票 IR 跟进行验证 verification 是不一样的一路谈到验证的时候怎么比对采购单 PO 跟收化 GR 的资讯，也了解了价格条件有分 master 跟 document condition， 计划内外的运费，还有那个看似源头但影响却很深远的物料主档设定，像是价格控制啦、评价类别啦、付款条件。我们也拆解了实际的操作步骤，一步或两步，预存或过账，还有过账之后会产出什么发票文件、会计文件，揭开了系统自动决定会计科目的神秘面纱。原来是看种类、动作、目的来查表，还介绍了像 ERS 发票计划这些可以提高效率的自动结算方式，以及管理风险不可或缺的差异处理跟付款冻结机制。最后还比较了 GR-based 跟 PO-based 的这两种控管模式的差异。希望这次的探索真的让你对这个串联起物料管理 MM 跟财务会计 FI 的关键桥梁有了一个更全面、更清晰的认识。
的确是，发票验证的最终目的，其实始终都是围绕着确保付款的准确性这件事情。它真的不仅仅是财务部门的工作而已，更是整个采购到付款 procure to pay 流程里面承先启后的一个非常重要的环节。要让这个流程能够顺畅、有效率，而且具有良好的内部控制，除了人员的操作之外，系统的基础设定更是关键中的关键。就像我们今天反复提到的，物料主档里面的价格控制方式，到底要用 S 还是 V？ 评价类别有没有正确地址派？供应商主档里的付款条件是不是要启用 GR-based IV？ 还有像是容差范围有没有合理的定义？自动科目决定的规则有没有设定好等等，这些都会直接影响到日常作业的效率，还有账务的品质。
这次的探索确实让我们看到一个看起来好像只是核对账单付钱的动作，背后竟然有这么多模组的协同运作，还有这么精密的系统逻辑在支撑着。那么在今天的深入探讨之后，最后留给你一个问题，让你带回去可以思考一下。在你目前的工作流程或者你所观察到的流程里面，有没有哪些环节可以试着应用我们今天谈到的这些概念来优化看看呢？比如说，有没有机会导入 ERS 自动结算来减少某些供应商的人工发票处理量，或者能不能透过更精确的去调整那个容差设定，来更有效的管理差异，减少不必要的付款冻结，同时又能兼顾到风险控制？可以思考一下，或许会有意想不到的改善空间哦。好的，非常感谢你的收听，期待下一次的
All right,
Deep
let's talk
Dive， 再
about
见喽。
something that happens every single day in pretty much every company, but most of us never see it. Invoice verification. Now, I know it sounds a little dry, but trust me, getting this process wrong can cost a company millions. It's basically the final checkpoint that makes sure a business pays for exactly what it ordered and not 1 cent more. Think about it like this. You get a bill in the mail. Do you just immediately pay it without looking? Probably not, right? You at least glance at it. You ask yourself, is this the price I expected? Did I actually get the thing I'm being charged for? Well, businesses do the exact same thing, just on a much, much bigger scale. And that simple, common sense check is really what this whole process is all about. And it's really important to get this one thing straight. Just because you've received an invoice doesn't mean you verified it. See, receiving a bill is passive. It just shows up. Verification, on the other hand, is an active process. It's an investigation. It's the company's own internal audit before any money actually walks out the door. So here's our roadmap for the next few minutes. We're going to start with why this is so important. Then we'll dive into the heart of it all, the three-way match. We'll look at how to deal with unexpected extra costs and what happens when things just don't line up. After that, we'll walk through the workflow. And finally, we'll see where all the money goes in the accounting records. Okay, so first up, why all the fuss? I mean, why go through all this trouble? Well, it really comes down to control and accuracy. Without a solid verification process, a company is just exposed. You could be overpaying for things, paying for shipments that never even arrived, or paying the wrong price for an item. This isn't just about shuffling papers. It's a critical financial shield. The whole point, the entire goal of invoice verification, can be boiled down to this one simple but really powerful idea. You have to make sure that what you're being billed for lines up perfectly with what you originally ordered and what you physically received. Those three things have to tell the exact same story. And that brings us right to the main event, the three-way match. If there's one thing you remember from this, it's this concept. This is the absolute gold standard for verifying an invoice, and as the name suggests, it's all about checking three crucial documents against each other. So let's meet our three main players. First, you've got the purchase order, or PO. That's the document you send to the supplier that says, hey, we want this many items at this specific price. It's your side of the agreement. Next, when the stuff actually shows up at your warehouse, you create a goods receipt, or GR. That's your proof of what you actually received. And the final piece of the puzzle is the invoice. That's the bill from the supplier telling you what they're charging you. The magic happens when all three of these line up perfectly. Now, this is where it gets really clever, especially in big systems like SAP. The system doesn't just look at the invoice in a vacuum. It treats that original purchase order as the ultimate source of truth. It's smart enough to check the PO's history to see if you've already paid for part of this order. It can even go look at a master contract to double-check the pricing. So it's not just one check. It's this multi-layered verification that happens in a flash. But, the real world is messy, right? It's not always that clean. Very often, invoices show up with extra charges on them that weren't part of the original deal. So how does the system deal with that? Well, these extra charges basically come in two flavors. First, you have planned costs. These are things you saw coming, like standard freight charges or customs fees, and you probably included them on the purchase order from the start. But then you have the unplanned costs. These are the curveballs, the surprise fees that pop up out of nowhere. And here's a perfect example. Let's say you're suddenly in a huge hurry for a part. You call up the supplier and say, hey, forget the slow truck, you have to send it by courier right now. Well, that courier fee wasn't on the original PO, so when the invoice comes in, that's an unplanned cost that has to be accounted for. Okay, so what happens when even after you account for all those extra costs, the numbers still don't add up? This is what's called a variance, and this is where the system's guardrails really come into play. For instance, let's say your purchase order said an item was $100, but the invoice from the supplier says it's $110. Boom, that's a price variance. Or maybe you ordered 100 widgets, but the invoice is billing you for 105. That's a quantity variance. The system is designed specifically to catch these exact kinds of mismatches. And this right here is the system's most important job. If that variance, that difference, is bigger than a limit that the company has set, something called a tolerance, the system just slams on the brakes. It puts a payment block on that invoice. No money is going anywhere until an actual person steps in, investigates the problem, and gives it the green light. It's the ultimate financial safety net. So, once an invoice makes its way into the system, it doesn't just get paid instantly. It has to go on a little journey, a specific workflow that usually involves a couple of key steps. Generally, there are two ways this can go down. You might have a simple one-step process where someone keys in the invoice details and posts it for payment all in one go, but a lot of companies prefer a two-step process for more control. In that scenario, one person might park the invoice, which is like saving it as a draft. Then someone else has to come in later, maybe a manager, to do the final verification and then post it. And that word, posting, is super important. Posting an invoice is the final official action. It's the moment you tell the system, yep, this bill is correct, it's legitimate, and it's approved for payment. Once an invoice is posted, the accounting process kicks in for real. So what's actually happening behind the curtain when someone hits that post button? Well, this is where the transaction officially hits the company's financial books. It's not just about paying a bill anymore, it's about recording everything accurately. The second an invoice gets posted, it triggers this whole chain reaction. The system creates a bunch of records, but the most important one is the official accounting document. This action updates a special account called the GR/IR account. We'll get to that in a sec. And crucially, it adds a liability to accounts payable. That's the official IOU that says the company now owes money to that supplier. And that GR/IR account, honestly, it's the secret sauce that makes this whole thing work so well. Think of it like a temporary holding area. When the goods arrive, a value goes into one side of the account. When the invoice is finally posted, a value goes into the other side. If everything matches up perfectly, the PO, the receipt, the invoice, the two sides cancel each other out, and the balance becomes zero. A zero balance is the system's way of saying, all good here, this transaction is complete and correct. So if you pull it all together, the big takeaway is this. The three-way match and this whole verification process, it isn't just tedious paperwork. It's a deeply important financial control. It's what stops fraud, prevents companies from overpaying, and makes sure the financial reports are telling the true story. And all of this leads to a pretty interesting final thought. So much of this matching process is already automated. So the question becomes, what's next? As AI gets smarter and smarter, could we get to a point where it handles almost all of these discrepancies on its own, only flagging the really tricky ones for humans to look at? Just something to think about. Thanks for watching.
Welcome to the Deep Dive, your shortcut to really getting a grip on complex enterprise systems. Today, we are cracking open the financial vault, looking right into the engine room where materials management meets finance. We're doing a full deep dive into invoice verification, focusing specifically on how systems like SAP, big ERPs, make sure everything's financially sound before any money goes out the door.
Yeah, this is such a critical step in the whole business process, isn't it? Invoice verification is really where the logistical agreements, what you ordered, what you received, slam into the hard facts of accounting. Our mission today is to basically give you the map, that shortcut to understanding the core logic, how the system checks an incoming supplier invoice against, well, everything the company agreed to or actually got. It's about bridging that MMM and FI gap.
Right, and the terminology itself can be a bit of a minefield. People often get tripped up here. When we say IR, especially in this context, we're not just talking about, getting the piece of paper or the PDF.
Exactly. Invoice receipt, which often gets shortened to IR, that's just the admin part. Supplier sends the invoice, someone keys in the data. Simple enough. But the real core is verification. That's the analytical piece. It's like the gatekeeper asking, okay, the supplier says we owe $100 each. Does our PO say that? Did we actually receive goods matching that? Is the price right? Or are we about to overpay?
So the whole point of verification really is about financial control. Pure and simple. Making sure that what you ultimately pay matches up with the purchase order, the PO, and this is key, what actually landed on your dock, the goods receipt, or GR. That's how you plug the leaks in procurement spending.
Absolutely. And your whole organizational setup needs to back this up. Our sources point out that typically the sheer volume of invoices dictates how companies handle this. Is it a one-step or a two-step process? In a one-step scenario, inputting the invoice and posting it, making it final, happens pretty much at the same time. It's faster. But in larger companies, you often see a two-step or even multi-step process. It gets separated. Maybe someone in the warehouse just enters the basic data, kind of parks the invoice electronically. Then a different department, maybe procurement, maybe finance, does the actual verification and the final posting.
Okay, but doesn't splitting it like they have the two-step thing, doesn't that slow things down? Delay payments, maybe upset suppliers. What's the trade-off? Speed versus control?
That's exactly the trade-off. Control over raw speed. Look, if you're dealing with hundreds of thousands of invoices, separating data entry from verification makes a lot of sense. You have specialized staff focused just on checking compliance, handling the exceptions, the problems. It cuts down the risk of errors or even fraud. Plus, the person who received the goods. They might not understand the payment terms, the tax rules, all that complexity. You don't want them accidentally releasing a huge payment they shouldn't. The volume is just too massive in big companies to rely on one person doing everything without that second check.
That makes total sense. Control has to be king when you're talking about cash flow. Okay, let's move into the mechanics then. So the invoice is in the system. It's waiting. Where does this system actually look to find the truth about the price, the quantity? What are the sources it verifies against?
Right, so the system is pretty logical about this. It follows a hierarchy, trying to use the most specific information available for that particular deal. The absolute foundation is the purchase order, the PO. That's ground zero. Verification checks the unit price on the invoice directly against the price listed on that specific PO line item.
But just checking the PO number isn't quite enough, is it? You need the history, the context of what's happened with that order already.
Absolutely crucial. The PO history is the system's memory. It prevents you from, well, verifying too much or paying twice. This history logs everything related to that PO line. Every goods receipt, every previous invoice that's already been verified, partial deliveries, you name it. So if the PO was for, say, 100 widgets, the PO history might show only 80 have actually arrived, and maybe 40 have already been invoiced and verified. The system uses that history to stop you, or at least warn you very loudly if you try to invoice for more than the remaining 40, especially if you've got strict GR-based verification turned on.
Okay, now what about longer-term deals? Things like contracts, standing quotes. This is the master condition data, right? How does that fit in when verifying a specific invoice against a specific PO?
Good question. So master condition data lives in things like the info record. That's usually for a specific supplier material combo, often holding shorter-term quotes, maybe valid for 3 or 6 months. Or it could be in a broader contract, like a long-term volume agreement. This is where your standard or list price usually comes from. Now, when you create a specific PO, the system typically pulls that price from the master condition and creates what's called a document condition on that specific PO. During invoice verification, the system checks against the PO's document condition.
Why the document condition on the PO? Why not just go back to the info record or the contract directly? What makes the PO's condition the definitive source at that moment?
Because the document condition on that specific PO is the live agreed-upon price for that particular transaction. It captures any temporary changes or specifics that might deviate from the master agreement. Maybe there is a last-minute discount for this one order, or a special handling fee just for the shipment, or maybe the currency rate changed that day. So while the price originates from the master condition, the document condition on the PO reflects the final immediate commercial terms for this invoice. It's the ultimate source of truth for that specific payment.
That level of detail makes sense. Procurement isn't just about the item cost either. You've got delivery cost to factor in.
Yeah.
And these seem to be split into planned versus unplanned.
Exactly. Planned delivery costs are the ones you know about up front when you create the PO. Think standard freight charges, often coded like FRs 01 in SAP, or customs duties, insurance, things like that. You enter these as specific conditions right on the PO. And importantly, if the material you're buying uses moving average price valuation, we'll probably touch on that more later, these planned costs usually get rolled into the inventory cost. So the cost of getting the item onto your shelf actually increases the asset value of that material.
Right. And then there are the curveballs, the unplanned delivery costs, the surprises that pop up after the PO is done.
Precisely. Maybe you needed a rush courier because of an urgent shortage, or the supplier hit you with some special handling charge nobody foresaw. Since they weren't planned conditions on the PO, they have to be added manually by the user during the invoice verification step itself. And crucially, these unplanned costs, often they can't be capitalized into inventory value. They usually hit an expense account straight away.
Okay, shifting gears a bit, let's look at the material itself. The material master record seems to hold huge sway over the financial outcome. Specifically, this price control setting the valuation. That sounds like a major strategic decision.
Oh, it absolutely defines your entire costing strategy. Huge implications. If a material is set to standard price, SS, you're essentially fixing a budget cost for that item, maybe reviewed once a year or quarterly. Now, if an invoice comes in and the price is higher than that fixed standard price, the system isolates that difference immediately. It posts it to a separate price difference account, usually an expense account. This keeps your inventory value stable and predictable, insulating it from market price swings. Great for budgeting.
And the alternative, moving average price, V, sometimes called MAP.
Right. Moving average price, or V, means the cost of your inventory is, well, constantly moving. It reflects the actual purchase prices more directly. If an invoice price is higher than the current moving average price in the system, that difference gets rolled into the inventory cost. The total value of your stock goes up, and the average unit cost recalculates based on this new purchase. The strategic trade-off is pretty stark. Standard price gives you cost stability and clear visibility of variances. Moving average gives you a more real-time cost reflection, but your inventory value can be much more volatile.
The material master is also pulling strings when it comes to cash flow through payment terms. How does this system prioritize which terms to use?
Payment terms are vital. They dictate when you pay your vendors, which impacts your treasury strategy. The system looks for the most specific agreement first. So, number one, it checks the payment terms specified directly on the PO. If the PO doesn't have one, it looks next at the info record for that supplier material combination. If that's blank too, then it falls back to the material master record. And even within the material master, there's a hierarchy. There's often a payment term in the purchasing view, which can be specific to how you buy that material, maybe reflecting a particular supplier deal, say net 30 days. And there might be a more general term in the company code view. Maybe the standard corporate policy is net 90 days. The more specific purchasing view term will always win if it exists. It ensures you honor specific vendor agreements while still having a corporate default. You know, all this talk about manual verification brings up a really important point. Not everything requires someone to manually check and post. There are scenarios, specific relationships, or material types where the system can handle the settlement pretty much automatically. Automated settlement.
Right, like evaluated receipt settlement, ERS. That's probably the best known one. What's the big advantage of ERS beyond just, saving keystrokes?
The strategic value of ERS is huge because it flips the script. You're not waiting for the vendor's invoice anymore. Instead, the company generates the payment document automatically, based purely on two things: the price agreed in the PO and the quantity confirmed in the goods receipt. That's it. This forces really tight internal control over your receiving process because any mistake in counting the goods at the dock directly leads to paying the wrong amount. Now, some places, like Taiwan, for example, have strict rules about needing a specific unified tax invoice from the supplier. But even there, companies often use ERS internally to generate a sort of settlement statement. The vendor then uses that statement to create their official tax invoice, so you still maintain that control and accuracy benefit.
Interesting. There are a couple of specific material situations that almost demand automatic settlement: consignment and pipeline materials.
Exactly. Consignment stock is where the vendor's material is sitting in your warehouse, but you don't own it yet. Legally, it's still theirs. You only pay. Settlement only happens when you actually withdraw or consume that material from your own stock. It's a true just-in-time cost model. Ownership transfers at the point of use. Pipeline materials are things like utilities, water, gas, electricity, maybe bulk chemicals delivered continuously through pipes. You don't really do a distinct goods receipt for each cubic meter. So settlement is periodic, usually monthly or bi-monthly based on meter readings. How much did you actually consume? The price is typically set per unit, like per therm or per gallon.
It sounds like for both of those, consignment and pipeline, the info record becomes absolutely essential, doesn't it?
It's the linchpin. It has to be set up correctly. Both consignment and pipeline processes rely on an info record to define the pricing conditions. How much do you pay per unit consumed or per billing period? Without that price defined in the info record, the system literally wouldn't know what cost to apply when you report consumption or when the billing period ends. Automation fails without that master data.
Okay, shifting from physical materials now, what about recurring expenses, things like rent, leases, maybe ongoing service contracts? This leads us to the invoice plan.
Invoice plans. They're really efficient for handling predictable fixed expenses over a set period. They cut down massively on admin work. You basically pre-schedule the expected payments. The fixed period type is perfect for things like, say, office rent or an equipment lease. You know it's going to be $5,000 every month for the next 3 years. You set it up once, and the system can generate the invoices automatically based on the schedule.
And the other type, installment, that sounds like it's more for projects or phased deliverables.
Exactly right. Think about a big consulting project or maybe a custom machine build. Payment isn't necessarily tied to a calendar date, but to milestones. The installment plan lets you schedule payments based on hitting those stages, maybe 20% up front, 30% after design approval, 50% on final delivery. You define those stages and amounts in the plan. And another neat feature of invoice plans is controlling when in the period the payment is due. Is rent due on the first of the month, or maybe at the end of the previous month? The plan lets you specify that.
Okay, before we get into the documents created by posting, there's a distinction we need to nail down. The difference between a regular down payment and this more specialized prepayment PPX function. People seem to mix these up.
Yeah, it's a common point of confusion, and the difference is quite technical but important. A standard down payment is really a pure financial accounting transaction, an FI document. You're basically advancing cash to your vendor. It hits your cash account, credit, and posts to a special reconciliation account for down payments made, debit. It's clean, handled entirely within FI. Prepayment, PPX, on the other hand, was an attempt, particularly in later SAT versions like ECC 6.0, to link that early payment more closely to the logistics process. The idea was you could potentially make a payment based on an invoice that was parked in the system even before the goods receipt was done, trying to tie the prepayment directly to the eventual invoice document.
But the sources we looked at were pretty clear that PPX has some major limitations in practice. Why is it so restricted?
Yeah. The constraints are significant, honestly. They make it unusable in many common scenarios. First, PPX often can't handle tax calculations properly. That immediately rules it out for countries with strict VAT or sales tax rules tied to the final invoice document and GR. It also has issues in specific tax jurisdictions, like the US sometimes. And the big one, it's generally incompatible if your company uses the material ledger for actual costing.
And material ledger is pretty common in manufacturing, right?
Very common, especially in complex environments. Since so many manufacturers use material ledger, that limitation alone sidelines PPX for a huge number of companies. It means, realistically, most businesses needing to prepay will just stick with the standard FI down payment process because it's simpler and avoids these compatibility headaches.
Right, okay. That clarifies the PPX situation. So now let's get to the moment of truth. The verification is done, everything looks okay, and someone hits the post button. What does posting actually do inside the system? What does it signify?
Posting is the point of no return, financially speaking. It means the transaction is considered final, complete, and irreversible in the normal course of business. It's the action that formally updates the company's financial ledgers, the general ledger. It creates the official accounting entry, the voucher. If you were using a two-step process where the invoice was parked first, hitting post is what converts that temporary parked document into a permanent, legally binding financial record.
And clicking post doesn't just create one document, right? It triggers a kind of chain reaction, generating linked documents across different modules. What are the main ones?
That's right, it's interconnected. Two documents are always generated simultaneously at minimum. First, you get the invoice document. This is technically an materials management document. It records the specifics from the verification vendor, items, quantities, prices, the PO it relates to. Think of it like the material document you get from a goods receipt. Second, generated at the exact same instant, is the accounting document. This is the FI financial accounting document, often just called the FI voucher. This holds the actual debit and credit lines that hit the general ledger accounts.
So you've got the invoice record and the FI accounting record. Are there other documents that might get created depending on what was being paid for?
Absolutely. If the invoice wasn't for standard inventory, but maybe for an overhead expense or something related to a project, the posting needs to allocate that cost correctly. So you might also see documents or postings generated that link the cost to a cost center for regular departmental expenses, or to a project if it's a capital expenditure tracked in SAP's Project System Module, PS, or maybe to an internal order, IO.
Internal orders seem interesting. They sound like a flexible way to track costs for specific things without setting up a massive project structure.
That's exactly what they are. IOs are super useful for collecting costs related to a specific activity or objective that isn't big enough or structured enough for a full PS project. Think about tracking the cost for a specific marketing campaign or an R&D initiative, or maybe refurbishing a small section of the office. You create an internal order, charge relevant expenses to it, and then usually at month end, you settle the total collected cost from the IO to its final destination, like a cost center, or maybe even an asset. They're great for temporary cost tracking and budget control.
And for manufacturers who build specifically for customer orders, the make-to-order or MTO scenario, the costs often need to end up linked to the sales order itself.
Precisely. If you buy materials or incur costs specifically to fulfill a particular customer's sales order, you absolutely want those costs captured against that sales order. This allows you to calculate the true profitability of that specific deal. So when the invoice for those MTO materials is posted, the system often directs the cost postings to accumulate on the relevant sales order cost collector.
Before we get to the final posting, let's quickly revisit those intermediate steps. Hold and park. People often confuse them. What's the fundamental difference? Why use one versus the other?
The key difference boils down to completeness and system visibility. When you hold an invoice, it's usually because the data entry is incomplete. Maybe you only entered the vendor and invoice date but got interrupted before adding line items. Holding creates only the document image like a visual draft. Crucially, it does not update the PO history, and it generates no FI documents at all, not even temporary ones. It's basically a personal save for later, invisible to the finance system.
Whereas parking is a much more formal step.
Much more formal, yes. When you park an invoice, often using transaction MIR7 in SAP, the assumption is that the data entry is complete, but it's just waiting for final checks or approval before posting. Parking generates the invoice document, and it updates the PO history, signaling that an invoice has arrived for those goods or services. Critically, it also creates the FI accounting document, but in a special parked status. It's visible in FI reports as a pending liability, but hasn't hit the main ledgers yet. This is essential in a two-step process, so the finance team reviewing parked documents knows what's in the pipeline, waiting for final verification and posting.
And some companies might even have a third step, like save as complete.
Yes, save as complete can act as an intermediate status between parked and posted. It often signifies that the initial data entry clerk has finished their part, and it might trigger a workflow for a manager or verifier to take the next step, which is either post or perhaps send it back if there's an issue. It adds another layer of control. Critical thinking is just so vital here. In this whole process, things rarely line up perfectly, do they?
Definitely not.
The invoice amount might be slightly off, the quantity different, the price changed. The system has to be built to handle these variances, these exceptions, in a controlled way. It's not about expecting perfection, it's about managing the differences.
And the core mechanism for managing the financial side of these differences is that famous GRR clearing account. It acts like a bridge, right?
Exactly. It's a crucial temporary holding account. Think of it like a suspense account specifically for goods and invoices in transit. When the goods receipt GR happens, the basic accounting is debit stock account or an expense account, credit GR clearing account. You've recorded the asset or expense and created this temporary liability. Then, when the invoice receipt IR is verified and posted, the accounting is debit GR/IR clearing account, credit vendor account, accounts payable. If the GR amount and the IR amount match perfectly, the debits and credits to the GR account cancel each other out. It goes back to zero. But if there's a difference, say, the invoice price is higher than the GR value, the GRR account won't clear to zero. That remaining balance is the system's flag saying, hey, there's a variance here, and that variance amount needs to be posted somewhere else, usually to a specific price difference account.
How the system handles quantity differences, though, seems to depend heavily on a key setting. GR-based verification versus the default PO-based verification. That sounds like a fundamental choice.
It's a massive strategic decision, usually set at the vendor level. If you check the GR-based verification box, often labeled GR-based 4, in the vendor master data, the system logic becomes very strict. Payment is tied directly and only to the quantity confirmed in a goods receipt document. So if you ordered 100, but the GR only shows 20 received, the system will not let you post an invoice for 100. It will usually throw a hard error, blocking the invoice, forcing the issue to be resolved, either get the rest of the goods or get a corrected invoice for just 20. It's the tightest control against paying for goods you don't physically have.
And if that box isn't checked, so you're using the default PO-based verification.
PO-based is more flexible, sometimes seen as more traditional. Here, the system primarily validates the invoice against the quantity ordered on the purchase order. So in that same scenario, ordered 100, received 20. If the supplier invoices for the full 100, the system might allow it to proceed. It sees the obligation stemming from the PO. However, it will almost certainly issue a warning message. And crucially, if the difference, the 80 units not yet received, exceeds the predefined tolerance limits, it will slap a payment block on that invoice even if it allows the posting. This PO-based approach is often used for services where invoicing might align with the contract value rather than phased delivery, or in industries where partial shipments are common and managing GR-based invoicing is considered too cumbersome.
Okay, you mentioned tolerance limits. The system needs rules to decide if a difference is just minor noise or a serious problem needing a block. That's where tolerance checks come in.
Exactly. These tolerances are configured in the system's backend, the IMG. They set the acceptable boundaries, upper and lower limits for variances. These limits can be defined as absolute amounts, for example, plus MAT is $10, or as percentages, for example, plus MAT is 5%. If a variance between the invoice and the POGR data falls outside these tolerance limits, the system typically flags it as an error, often shown in red, and automatically applies a payment block. If the variance is within the tolerance limits, it might just issue a warning, yellow, allowing the invoice posting, but maybe logging it for review later. Our sources highlighted about 7 main types of variances the system checks for.
Let's maybe focus on one of the trickier ones. Order price quantity variance, often coded as PP. Can you give us a concrete example of why that specific check is even needed? It sounds complex.
It is a bit complex, but necessary when your units of measure get tangled. The PP variance specifically handles situations where the unit you order in, like pieces, is different from the unit the price is actually calculated on in the PO condition, like kilograms, even if there's a standard conversion. Imagine you buy steel rods. You order 1,000 pieces, PC. The price on the PO condition, however, is set as $10 per kilogram, kg. The standard conversion in the system is 1 PC equals 2 kg. So you expect the order to be for 2,000 kg, costing $20,000. But maybe due to manufacturing variations, the actual 1,000 pieces you receive weigh slightly more, say 2,050 kg. The invoice arrives based on the actual weight shipped, billing you for 2,050 kg at 10 kg, which is $20,500. Your piece count, 1,000 PC, matches the GR, but the underlying pricing unit, kg, doesn't align perfectly with the standard conversion from the ordered unit PC. That $500 difference, arising because the order price quantity, kg, deviated from the expected quantity based on the order quantity PC, is what triggers the PP variance check. It ensures you pay based on the actual metric used for pricing.
Wow, that is incredibly granular. Okay. What about a more straightforward quantity variance? What happens if that goes way over tolerance?
Let's stick with PO-based IR for this example and say your quantity variance tolerance is 5%. You order 100 units, your supplier only ships 50, so the GR is for 50, but they send an invoice for the full 100 units. The quantity variance here is 50 units, 100 invoiced, 50 received. That's a 100% variance based on the received quantity, or 50% based on the ordered quantity. Either way, it's way over the 5% tolerance. The system will flag this as a hard error. It will automatically apply a payment block, often type Q for quantity, to the invoice during posting. This prevents finance from actually paying that invoice until someone investigates why you're being billed for double the quantity received and manually releases the block. It forces that investigation.
Makes sense. And the other key variances are things like price variance, invoice price versus PO price, bait variance, goods arriving way too early, messing up payment term calculations, inspection, payment blocked if goods are still stuck in quality checks, and of course, a manual block where a user deliberately stops payment for some reason.
Right. And any of these significant variances, once detected, result in that payment block being applied to the invoice line item. This block, often represented by a code, is a flag telling the payment program, usually run by FI, do not pay this item. These blocks need active management. Most companies run regular jobs, often daily, using transactions like MRBR in SAP to review blocked invoices. This job checks if the reason for the block has been resolved. For example, have the goods finally passed inspection? Has a missing GR been posted? If the blocking condition is gone, the system can often automatically release the block, clearing the invoice for the next payment run. Or someone has to manually review and release it.
Okay, what about that awkward situation where the supplier definitely overbilled, you say, quantity error, but they refuse to take the invoice back and issue a new one? You need to process something. This is where invoice reduction comes in.
Yes, invoice reduction is a neat way to handle that exact scenario pragmatically. You want to process the document the supplier sent, but you absolutely don't want to pay the wrong amount. So let's say they invoice for 100 units, but you know for a fact you only received and accepted 70. Using invoice reduction, you process the invoice for the full 100 units as it appears on their document. But in the same transaction, the system simultaneously generates an offsetting credit memo document internally for the value of the difference, the 30 units you didn't get or are disputing. You typically have to select a specific reason code for the reduction. The net effect is that accounts payable now shows the liability for the full 100 immediately offset by the credit for 30. So when the payment run happens, only the net amount for 70 units is actually paid. It keeps the document flow clean based on the supplier's paper, but ensures the payment is correct without needing them to reissue the invoice.
Right, that makes sense. Okay, now we need to connect all these dots, all this verification, tolerance checks, posting. What does it actually mean for the company's financial books, the general ledger? This is where the system translates MM actions into FI entries. the real accounting logic.
This is the heart of it, the bit that often seems like magic but is pure configuration logic. And yes, we have to quickly revisit price control one last time because it dictates the path the money takes in the GL. If the material uses standard price, S, and there's a price variance during invoice verification, say the invoice price is higher, the system uses a specific transaction event key, or TEC, called PRD, price difference. This PRD key is configured to point directly to a specific price difference expense account in the general ledger, maybe GL account 6 to 500 purchase price variance. The variance amount goes straight there, keeping the inventory value at standard.
But if the material is using moving average price,
then that PRD key is essentially ignored for price variances at invoice time. The system instead adjusts the value posted to the stock account itself using the TEC BSX balance sheet stock account. The variance gets absorbed into the inventory value on the balance sheet. No separate expense posting for the variance itself.
so the price control sets the stage. But determining the exact GL account number seems incredibly complex. How does the system figure out which stock account or which expense account to use? The sources mentioned 3 core determinants.
It is complex behind the scenes, but it relies on the system aligning 3 key pieces of information. Get anyone wrong in the master data or configuration, and your costs end up in the wrong place, which is a financial reporting nightmare.
Okay, what's the first piece?
First is the material type combined with its assigned valuation class. Material type is basic categorization. For example, ROH for raw materials, FERT for finished goods. The valuation class is a mandatory code you assign in the material master's accounting view. For example, maybe 3000 represents all basic raw steel, 3040 for packaging materials. This valuation class acts as the primary bridge linking that specific material or group of materials to the general ledger accounts. All materials with the same valuation class will generally hit the same set of GL accounts for inventory postings.
Okay, material type and valuation class. What's the second determinant? Something organizational.
Yes. The second is the valuation area, which is typically defined as either the plant or the company code where the transaction is happening. And optionally, layered on top of that, is the valuation grouping code. Now, this valuation grouping code is a powerful, often underutilized strategic tool. It allows you to group multiple plants, valuation areas, together. Why? It lets you use different GL accounts for the exact same transaction, like a goods issue, involving the exact same material valuation class, but happening in different plants or groups of plants, even if they all share the same chart of accounts.
Why would a company need that level of flexibility? Give me an example. Imagine a global company. They have a raw material, valuation class 3000. In their U.S. manufacturing plants, when this material is issued to production, they want it to hit standard cost of goods sold accounts, say GL 500-100, standard practice. But maybe their R&D facility in Germany, which is a separate plant, valuation area, uses the same raw material, valuation class 3000, but purely for experiments. They don't want those costs hitting COGS. They need them to hit a specific R&D expense account, say GL 550-100. The valuation grouping code allows the German plant to be assigned to a different group. The system configuration can then say, for valuation class 3000, movement type 261, goods issued to order, if the plant is in group 0001, US MFG, use GL 500-100. But if the plant is in group 0002, German R&D, use GL 550-100. It enables geographically or functionally tailored accounting within a single system.
That's really powerful. Okay, so we have material valuation class and org structure grouping code. What's the third piece? The transaction itself. Exactly. The third determinant is the specific business transaction represented by the movement type, like 101 for GR, 201 for goods issued to cost center, and its associated transaction event keys, TE cakes, sometimes influenced by an account modifier. The movement type basically tells the system what is happening logistically. Behind each movement type is a value string, which dictates the underlying financial posting logic. That value string points to a set of TECs. These TECs are the system's internal codes, the vocabulary that tell it which type of account needs to be debited and which type needs to be credited for that specific movement.
Okay, let's make this concrete. Walk me through a simple goods receipt again. Movement type 101, receiving $1,000 of that raw material with valuation class 3000. Which TECs fire and what do they do?
Right. Movement type 101, GR for PO. The system looks at its configuration for this movement. It sees it needs to make 2 main postings. First, it needs to increase inventory value. It uses the TEC BSX, which stands for balance sheet stock account posting. BSX tells the system, find the stock GL account linked to valuation class 3000 for this plan. Let's say that's GL 141,000. So it posts a debit of $1,000 to GL 141,000 BSX.
Okay, debit stock. What's the credit?
The credit needs to go to that temporary liability account we discussed. The system uses the tech WRX GRR clearing account. WRX tells the system, find the configured GRR clearing GL account. Let's say that's GL 2100. So it posts the corresponding credit of $1,000 to GL 2100 WRX. So the full GR journal entry is debit inventory GL 141,000 BSX Banque, credit GRR GL 2100 WRX $1 balanced.
Perfect. Now follow that up. We verify the invoice for that same $1,000, no price difference. What happens with the text now?
Okay, invoice receipt, IR posting. The system needs to clear that GRR liability and create the actual payable to the vendor. It again uses WRX. To clear the previous credit, it now posts a debit of $1,000 to the GRR GL account 2100 WRX. The corresponding credit goes to the vendor reconciliation account in accounts payable. This part is handled automatically by the system linking to the vendor subledger. You don't usually see a specific tech for the vendor line itself in the MMFI setup, but the result is credit AP. So WRX is cleared, liability is now with the vendor.
Got it. Now, one more inventory consumption. Let's say we issue $100 of that raw material, valuation class 3000, directly to a department's cost center using movement type 201. Which techs are involved here?
Right, movement type 201 goods issued to cost center. Inventory is leaving, so we need to decrease the stock value. The system uses BSX again, but this time posts a credit of $100 to the stock GL account 141,000 BSX. Now, where does the offsetting debit go? This is where it gets interesting. The system uses the tech GBZ offsetting entry for inventory posting. GBB generally points to expense or consumption type accounts.
And GBB often has that account modifier thing attached.
Exactly. For a movement type like 201, issued to cost center, the GBB transaction is typically paired with an account modifier, often VBR, consumption for internal goods issues. This GBB-VBR combination tells the system, find the specific consumption expensed GL account linked to valuation class 3000 for issues to cost centers. Let's say that's configured as GL 511,000 operating supplies expense. So the system posts the debit of $100 to GL 511,000, GBB-VBR. The logic flow is movement 201 triggers GBB with modifier VBR system checks, valuation class 3000 finds GL account 511,000, debit expense 511,000, credit stock 141,000.
It really is like a multi-dimensional map, isn't it?
Yeah.
This whole thing seems to boil down to what some of our sources called the 9-block matrix idea conceptually anyway.
Yeah.
The ultimate alignment.
That's a great way to visualize it. The 9-block matrix isn't a specific screen, but a concept representing the mandatory alignment of those three core components we just discussed. 1, what is the material type valuation class? 2, where is it happening? Organizational structure valuation area grouping code. 3, what is the business transaction? Movement type take account modifier. Get those three things correctly defined and linked in your system configuration and master data, and the system will determine the correct final general ledger accounts automatically for pretty much any transaction. That linkage is the absolute bedrock of financial integrity in an integrated ERP system. Every physical movement or invoice verification should have a predictable, immediate, and auditable financial footprint.
Wow. Okay. We started this just wanting to understand how a supplier invoice gets checked, and we've ended up deep in the architectural blueprints of cost accounting that drive these massive systems.
It's quite a journey, isn't it? But the key takeaway for you listening is this. Invoice verification isn't just admin. It is arguably the most critical financial control point in the entire procure-to-pay cycle. And it works because of this rigorous, automated system of checks, constantly linking back to the purchase order promises, the goods receipt reality, and the strategic choices embedded in the material master's valuation settings.
Right. And while company policy gives you flexibility on the surface, like choosing one-step versus two-step processing, setting those specific tolerance levels for variances, deciding between PO-based or the stricter GR-based verification.
The underlying accounting rules are pretty rigid, enforced by that complex web of transaction event keys, BSX, WRX, GBB, PRD, and how they interact with the valuation class assigned to the material. That hidden logic is what ensures costs ultimately land in the right bucket. Stock on the balance sheet, price difference variance, or an expense on the P&L.
Which brings us to our final thought for you today.
Yeah, something to chew on. If a company makes a conscious decision to use the gross method for invoice processing, meaning they only figure out and take cash discounts right at the very end, when finance actually makes the payment, rather than netting it off earlier, what does that seemingly small accounting policy choice tell you about the internal power balance, the push and pull between the finance or treasury department, focused on cash preservation, and the purchasing department, often incentivized to get the lowest upfront price, including those early payment discounts? When the system design forces a choice between potentially losing a 2% discount versus holding on to cash longer, whose priority is the buyer wanting the discount or the treasurer wanting the float, do those deep accounting configurations ultimately serve?
Something to definitely think about next time you're looking at payment strategies or vendor negotiations. That's all for this deep dive. Thanks for joining us.
See you next time.